In this video, we're going to have a look at one of the most controversial stock available on the stock market right now. They became famous for their short squeeze in 2021. They are the provider for nostalgia for many people. Of course, I'm talking about none other than Gamestop. Gamestop recently released their 2023 annual report here because their fiscal year moves from January 31st to January 31st. So they recently released their annual report. And in that annual report, we can see exactly what they've been up to here for the last year. Quite recently, they've introduced a new NFT platform, which has actually shown very unimpressive revenue and EBITDA numbers. So let's have a look over at their 10-year history. Let's see, based on an intrinsic value level, whether or not we think that GameStop is a right investment right now, and if we buy it right now and hold it for a decade, can we expect to outperform the market? Of course, GameStop is mostly known not because of their intrinsic value, but more so because of the speculation around it, because of course of the short squeeze potential around it. They have an entire Reddit dedicated to them on Reddit with a lot of loyal followers buying shares day in and day out and directly registering them and taking them out of the overall pool here. So of course GameStop is a very interesting stock for many reasons, but let's see whether or not it's also an interesting stock to buy for intrinsic reasons. So looking at the revenue here, we can see a steadily decreasing revenue for the past 10 years, decreasing by 4.1% annually. 2014 until 2019 were definitely their golden ages, where they didn't just sell new video games, they also very much resold existing video games, second-hand video games, put a markup on it and tried to resell them once again. They had a very interesting and lucrative business model, but of course, because the gaming industry has digitalized a lot, GameStop has become less and less important in the grand scheme of things. The existence of Steam or Epic Games has definitely taken a lot of customers away from GameStop, so we definitely see their revenue and their earnings numbers decrease after this point in time. GameStop has not really evolved that much for the past 10 years, apart of course from the last year where they introduced an NFT platform. Looking at the EBITDA numbers, so this is the earnings before interest, taxes, depreciation and amortization. We can see here that for the past 1, 2, 3, 4, 5 years, they have not turned a profit. They've been bleeding cash every single year for the past 5 years. And I think even right now, there's not really an end in sight to stop the bleeding. They have a lot of brick and mortar stores and their revenue and earnings numbers are simply not covering all the expenses that they have at the current time. So I definitely think that GameStop needs to reinvent themselves to kind of create a positive cash flow here. Looking at that debt level, it tells a very interesting story where they were basically debtless in 2014, then they slowly but surely started accruing a lot more debt, and for the past few years they are basically with no debt on the balance sheet. All the debt that you do still see here are mostly lease obligations that they have for the brick and mortar stores and not so much long-term banknotes. They have basically none of that. They are basically unleveraged right now, which is of course very interesting to see. They also have a massive pile of cash that they are sitting on, a massive war chest that they can actually use to reinvent themselves here into the future. Their market cap has remained stable here for the past 10 years. 5.8 billion in 2014, 5.7 billion in 2023, where we see a massive spike of around 11 billion in 2022, which is of course just after the short squeeze, which very much influenced this number. Enterprise value is the entire value of the business, so you take the market cap to which you then add the debt and we subtract the cash. And because they have more cash on their balance sheet than they have debt, of course we see that enterprise value has decreased faster than market cap, decreasing by 2% annually. EV/EBITDA, how many years of EBITDA does it take for a company to buy back the entirety of their enterprise value? Now for GameStop, this number is a little bit tricky here because they have had negative earnings for the past 5 years, so their EV/EBITDA ratio is definitely a bit skewed here because of this. But the moment that we look at their actually golden years, 2014, 2018, we can see an overall EV/EBITDA ratio of around the 5 times, give or take. Net debt to EBITDA, it shows a higher multiple than 5.5 times right now, simply because their earnings is just negative. It shows a high multiple here because right now their earnings is negative and their net debt is also negative because they have more cash on the balance sheet than they have debt. It's not something that you see quite often. Most of the time you actually don't see this, so it's a bit weird. But even though it says 5.5 times, do know that they are basically unleveraged, and it's basically dividing the negative net debt by the negative EBITDA, which gives us a positive net debt to EBITDA number here on our formula sheet. But do know that they are basically unleveraged, their debt level is basically zero, and they have a lot of cash in their war chest. So I don't think there's any risk of GameStop going into bankruptcy sometimes in the next few years. But do keep in mind they are not profitable here for the past few years, so if they continue to operate the way they have been doing for the last 5 years, I do expect them to get into a risky territory, let's say 10 years from now. So this then brings me over to their cash flow statement, which tells a very similar story, I think, to their revenue and EBITDA statements, which is to say they have some very positive cash flow from operations here in the first 5 years of our history, but for the last few years they have shown some very negative numbers here, minus 414, minus 434. Their cash flow from operations has been decreasing by 18% annually, which is not something that you want to see. It's actually quite a big drop here. Capital expenditures, all the money that they put back into the business to keep on maintaining their operations and also future-proofing it. So we're talking about a new coat of paint for their brick and mortar stores. We're talking about new uniforms, we're talking about new equipment, we're talking about new anything that you need to keep on future-proofing your store. And we can see that for the past 10 years, they've been heavily reducing their capital expenditures, which is of course very nice to see. They are more efficient with the way that they utilize their money, and they are cutting costs here on capital expenditure. At the same time, it also means that they don't really reinvest into their operations right now. So I think to expect them to suddenly post a positive earnings or positive cash flow is not really in the cards based on how much they invest back into their business. The moment that you take the cash flow from operations and you subtract the capital expenditure, you get the free cash flow, which is basically your pro rata ownership of the company. This is all the money that's available to you at the end of the fiscal year to be handed out in the way of dividends or share buybacks or buy back their debt or do some additional acquisitions. And we can see that for GameStop, they don't really have debt to buy back, so that's definitely not an option. They have been actively buying back shares for the first 5 years, but for the last 3 years we can see that they've been heavily diluting their share count. Of course, it's no wonder because their share price was absolutely insane. It reached as high as $300 per share because of this short squeeze, and of course GameStop very much utilized that and sold a lot of their shares to gain a lot of capital. This is where the war chest is coming from. They basically sold a lot of their shares on the open market, and this is how they got a lot of the excess cash that we see on their balance sheet. They basically got that from the investors by diluting the share count. The moment that you divide the free cash flow by the amount of shares outstanding, you get the free cash flow per share. And this number has been fluctuating quite a bit here for the past 10 years. Positive $1 in 2014, negative $1 in 2020, and positive about 17 cents here in 2023. Price per share, so this is the price on the open market itself, has started at $12 in 2014 and right now it's $18 per share in 2023. Do keep in mind that they did have some stock splits in their history, so if you see a very different numbers than this, do know that it might be because of that. The free cash flow yield basically tells you how much their free cash flow covers the current price per share on the open market. And we can see for the past 10 years very deviating numbers, but the moment that we look at their golden years, so to say, I think we see a free cash flow yield around the 10 to 13% here. So this then puts us into the business of trying to forecast GameStop into the future, which is by all means a very tricky thing to do because their earnings have been all over the place for the past 10 years. And I'm going to give them a bit of a rose-colored projection here into the future. I'm going to say that for the next 3 years, they are still posting negative earnings, but after that, I expect some kind of turnaround. Maybe because they have digitalized their stores, maybe because they've become more efficient, or maybe the NFT marketplace is really taking off. I don't expect it to happen, but I can envision that it might. and therefore I expect them with my projection to be cash flow positive in 2028. And after that I'm going to expect an EBITDA growth of about 10% annually. Because they have very low starting numbers, I do think it's a very possible thing for them to achieve here. I'm also going to attach a multiple of 5 times, which is about their historic average the moment that you look at their normal operating years and not so much their wacky years where we see a massive market cap with negative earnings. So these numbers very much skew the actual numbers. I think 5 times is an accurate number here for GameStop. So this gives me an enterprise value 10 years from now of $805 million, from which we then subtract the debt, we add the cash, gives us a market cap of $2.1 billion, mostly influenced by the massive war chest that they currently have. Divide this by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same. I can also see them dilute their share count quite a bit more, because I think even right now the share price on an intrinsic level is way too high for what the company is actually producing. Nevertheless, this gives me a stock price 10 years from now, so in 2033, of $7.13. And for their free cash flow projection, I'm going to do a very similar thing. I'm going to take their 2023 number of 17 cents, and I'm going to grow that by 10% for the next 5 years and 6% for the years after that. I think this is a very optimistic view here, because GameStop has been posting very negative cash flow numbers here for the past few years, and I'm assuming here that they don't post any more negative numbers. I'm going to assume that GameStop is only going to grow their cash flow in the next 10 years. I'm also going to attach a yield to GameStop of 15%, which I think is about the average number here during their golden years, and this gives me a stock price 10 years from now of $2.46. Taking both my projection of the free cash flow model as well as the enterprise value model, I get an average share price 10 years from now of $4.79. Right now I can buy as many shares of GameStop as I want for $22.97. So simply looking at the price on the open market itself on an intrinsic basis, I expect a compounding annual growth rate of minus 14.5%, meaning I expect you to lose about 15% of your investment every single year simply for holding GameStop. The moment that we include their free cash flow as projected in their free cash flow model, I expect an IRR of 13%. Not much higher, but definitely a little bit. Nevertheless, I still expect you to lose money if you invest in GameStop. So let's see what happens if the price goes up or comes down a little bit. I think even if the price drops with another 30% to the $16 range, I still expect a negative IRR here for GameStop. I still expect you to start losing money. I think the moment I'll be interested in GameStop again is the moment that the price reaches about $1 per share. Of course, many of the people who invest in GameStop do not invest in GameStop because of the intrinsic value that they have. They invest in GameStop because they want to stick it to the hedge funds, they want to join the direct registration movement, and they're hoping for a short squeeze. If that's your reason for investing in GameStop, more power to you as far as I'm concerned. But based on an intrinsic level, I don't expect you to make a profit by buying GameStop stock right now. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio.